It's time to say goodbye to hold music and say hello to fast customer support with Service Cloud. With trusted AI and data working together, you can skip long wait times and deliver efficient, personalized service right away, all while keeping support costs low and more customers happy. Reimagine your customer support with the #1 AI CRM for service. Learn what's possible at salesforce.com/products/service.
Are you looking for a podcast that's entertaining, more bingeable than your favorite Netflix show, and informative? The Personal Finance Podcast teaches you the hacks, tips, and tactics you need to upgrade your money, all while spending less and saving more. This isn't a show that teaches you to save money by clipping coupons. It's much more about learning how to build generational wealth and spending your money on the things you love. Search for the Personal Finance Podcast on Apple Podcasts, Spotify, or wherever you listen to podcasts. Your wallet will thank you later. This is Optimal Finance Daily, episode 2560. Investment Fees Are the Worst by Wanderer of Millennial-Revolution.com. And I'm your host and personal finance enthusiast, Diana Merriam. We're going to jump right into today's post as we optimize your life. Investment Fees Are the Worst by Wanderer of Millennial-Revolution.com. Fees suck, am I right? I know, such a bold statement to make. Fees are bad, from parking tickets to gym memberships to whatever the bloody hell Ticketmaster's convenience fee is for. Whenever I see the word fee written on something, a tiny piece of my soul and wallet dies a little. But out of all of the fees we have to put up with, one stands out as simultaneously the most damaging and the most misunderstood: investment fees. Quick, how much are you paying to invest? If you have no idea, you're not alone. Investment fees usually don't appear in your statement and are instead embedded inside your mutual fund and taken silently out of the fund's performance. Why would they do this? Simple. If you saw a line item that said $500 fee, you'd call someone up and scream at them. But if your mutual fund just goes up slower than it should, you don't notice. It's brilliant. And lucky you, we here in Canada have among the highest investment fees in the world. All mutual funds and ETFs have an embedded fee called a management expense ratio, or MER. This pays for the cost of running the fund, paying all those analysts and salespeople, as well as the cost of marketing and advertising, and is usually given as a percentage of the fund's total value. Finding a fund's MER may be as straightforward as just looking at the fund's webpage, but if it's not there, it's required to be shown in the fund's prospectus. As an example, I went to a certain bank site and picked its Canadian equity fund. At the bottom, there was a tiny link named Fund Financial Reports and Prospectuses. And that led me to the fund's prospectus. When I clicked on that link, I saw a description of what the fund invests in, their top 10 holdings, and the MER, which is a whopping 2.39%. And I don't think I'm picking on that particular bank for sucking here. All the banks do this. In fact, the average MER of equity funds in Canada is 2.42%. So technically, this fund is slightly better, I guess. Sorry, it's just so hard to contain my excitement. Meanwhile, an ETF tracking the TSX, which by the way, holds many of the same companies that Canadian equity fund up there is holding, has an MER of 0.06%. That's right, 0.06%, almost 40 times lower than a bank-run mutual fund. Why is this important? Because any ongoing percentage fee eats into your fund's performance. And just like gains can compound over time, fees compound also. Over sufficiently large periods of time, a couple percentage points paid to your fund can result in massive differences. Let's pretend, for example's sake, that we went back 25 years and wanted to invest $100,000 in the TSX. So January 1st, 1990, we buy $100,000 worth of either that mutual fund with a 2.42% MER or the ETF with a 0.06% MER. On January 1st, 2016, what does our investment look like? In a graph on this post comparing the low-cost ETF and the higher-cost mutual fund, you'll notice that while the lines start off at the same point, the difference between them grows and grows as the fees eat into our fund's compounded growth. And at the end, we're left with a huge gaping chasm. That gap is worth $100,000 just in fees. And here's the wild part. For most things, paying more money equals better quality, right? An expensive car is better than a cheap car. An expensive laptop is better than a cheap laptop, etc. This is not one of those times. Paying more does not mean a better product. In fact, when it comes to investing, the opposite is true. The more you pay, the worse the performance, because that fee just eats into your returns. So what should you do? First of all, if you're looking at a fund and you can't figure out its MER, do not buy it. Secondly, if a fund discloses its MER and it's above 1%, do not buy it. No mutual fund or ETF has a chance of giving you the performance you need with a handicap that big. Mutual funds versus ETFs. Generally, ETFs have a much lower fee than mutual funds. So a good rule of thumb is to always use ETFs over mutual funds. There's one caveat though, and it's to do with trading commissions. Mutual funds generally cost nothing to buy or sell. This is because the cost of trading is built into the higher MER. ETFs, however, are traded on the stock exchange, so there's generally a per transaction cost to buy or sell. For TD Waterhouse, the cost to trade is $9.99 per transaction. They also offer low-cost mutual funds called E-Series funds, designed for index investing and with considerably lower fees than other bank-run funds. The Canadian Index E-Series fund, for example, has an MER of only 0.33%. While we were working and self-directing our investments, we would dump money into our investment accounts with each paycheck and buy more units of each mutual fund in our portfolio. We were using 4 funds at the time: bonds, TSX, S&P 500, and international. Had we done this using ETFs, we would have racked up $10 times 4 trades per paycheck times 2 paychecks a month times 12 months, which equals $960 a year in transaction costs alone. In that scenario, it made more sense to use the E-Series mutual fund to dump our paychecks into it. And then when that total balance got big enough that the higher MER started to become expensive, we used $100,000 as our cutoff point. We sold the mutual funds and rolled it into ETFs that track the same indexes to take advantage of the lower MER. But that was then. There are many more options for low-cost brokerages now. Recently, our readers have alerted us to a whole slew of them, like Questrade and Qtrade. And for Questrade, you don't even need to pay to buy ETFs, only to sell. And since it's gotten so many good reviews, we're going to try it ourselves and report back the results. So there you have it. Fees suck, avoid at all costs by using ETFs. The only time you should ever use mutual funds is if the transaction costs are greater than the difference in the MER. You just listened to the post titled, "Investment Fees Are the Worst" by Wanderer of millennial-revolution.com. Labor strikes, climate change, your beat up office printer. What do they all have in common? Come on, it's all about the money. Economics is everywhere and everything, fueling our lives, even where we least expect it. If you're a fan of Optimal Finance Daily and are curious to learn something new and exciting about economics every week, I recommend you listen to the Planet Money podcast from NPR. Planet Money is a different kind of world where the complex economy actually makes sense, where human stories supersede abstract theories. For example, credit scores may sound complex, but Planet Money can give you simple tips so that you can make better financial decisions. And Planet Money also answers some of life's burning questions, like, will AI take over our jobs? And why are Christmas trees so darn expensive? The Planet Money team lives to tell a good story in around 30 minutes. It's econ for the rest of us. Tune in to Planet Money every week for entertaining stories and insights about how money shapes our world. Stories that can't be found anywhere else. Listen now to Planet Money from NPR, wherever you get your podcasts. There are lots of ways to potentially boost your investments these days, and even more options on where to stash them. Make the smart move by transferring your brokerage account over to Robinhood. Whether you're transferring $1,000 or $2 million, don't miss out on Robinhood's offer for an unlimited 1% bonus on your assets. Unlimited, as in no cap. See why over 3 million people have rated Robinhood 5 stars on the App Store. Visit Robinhood.com/optimal to claim your bonus. Terms apply to the bonus. See full bonus terms at Robinhood.com. Investments offered through Robinhood Financial LLC. Investing is risky. While fees might not seem like that big of a deal at first glance, it's actually one of the only elements of control we have over performance. No one has a crystal ball and can predict with any accuracy how a fund will perform long term. But we do know that fees compound over time and erode performance. In other words, the lower the fees, the better the expected performance. My friend Jeremy Schneider over at Personal Finance Club said it well in a recent Instagram post. He says, quote, "These fees can be tricky to spot. Any mutual fund or ETF you buy has an expense ratio. I consider any expense ratio under 0.2% to be very low and anything over 1% to be very expensive. Some funds also have loads, which is a transaction fee. Some trades incur transaction fees. Some financial advisors charge sweep fees, annual fees, statement fees, etc. The best way to identify your fees is to check all your expense ratios, then look closely at your statements for any other fees being taken out of the money you put in." And that'll do it for another edition of Optimal Finance Daily. Thank you so much for subscribing or following the show and sharing with others. Have a great rest of your day, and I'll see you tomorrow where your optimal life awaits.